Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today we are discussing units versus houses. Let's dig into the data. What performs better? What is better to buy when building a portfolio? So let's start by using a suburb in Brisbane that we have been buying in over the last 4 to 5 years. But as of say mid-late 2024, we're no longer buying in Brisbane as there's better value found elsewhere as it has clearly hooked into the growth cycle and is going gangbusters. So we're going to start with Woodridge. It's in the Logan City Council LGA area. So for those who don't know, Woodridge, blue collar working class area that's gentrifying. That is about half an hour south of Brisbane on the train line, hooked up with all the infrastructure, and also about 45 minutes or so north of the Gold Coast. So perfect spot. Here's the Gold Coast, and here's Brisbane. I really like the Logan area. It's flat, out of the floodplain, and it will only gentrify. Similar market in Sydney to compare it to would be, say, Parramatta in Sydney. However, Woodridge, Logan, this whole area is probably a good 20 or 30 years behind what is going on in Parramatta these days. Those who know what Parramatta was like 20 years ago, it's similar to what the Logan City area is like today. So in time, this whole area will definitely gentrify. It's getting a lot of investment already, but it is a perfect spot to invest between two major CBDs, being Brisbane and the Gold Coast. However, we're no longer buying there because we started buying units in Woodridge for around 150,000, and we stopped buying around the Logan area towards around 280, 290,000. So these days, most units are selling well over 400,000. But as you can see, we're in a similar point of the cycle in 2005. Sure, there'll be a couple of more, probably 30, 40% growth, say max, but once over the next 2 to 3 years, it'll then switch off and go through a protracted period of time. So we use these 20 years of sales data and overlay on the 18-year land cycle to calculate which market is still going to see substantial growth. So similar point of the cycle, 2005. So in terms of units, let's calculate how much growth Woodridge potentially will get over the next 3 years until it'll mark the top will be around 2027 based off history. So 2005, 2000, so there's 3 more years worth of growth before it'll then start its subdued up and down flat to negative growth, which can last up to 12, 13 years, never more than really 8 or 9 and never less than 8 or 9, never greater than 12 or 13, but on average around 10 years, markets go through flat to subdued growth. So we like to get in before they hook through the growth cycles, and then probably around halfway through a growth cycle, we then start looking elsewhere to find better value. So, but Woodridge for a unit has got another 6% probably expected this year based off history, plus 16.2 plus 39.7. So history doesn't repeat, but it rhymes. So you can probably expect another, say, 50% growth in the units in Woodridge. However, we started buying in Woodridge, Logan area, the same suburbs surrounding between 2019 to 2020, yeah, four, mid late 24. But as of, 2025 and onwards, we are pulling up stumps for that market, and we're looking elsewhere as you can get better value elsewhere. So we started buying around the 150K mark and stopped around the 280, 290 mark. And they've had significant growth over the last couple of years. So reason for this video is I want to run through apples for apples, same suburb, units versus houses. So this is the same pattern for the houses. The houses probably will have lesser growth in the coming years, but pretty much similar. So 37.8. Let's have a look. So 62. So 7.9 plus 14.5 plus 30.7. 53% growth expected from houses over the next 3 years based off history of what happened in 2005, 6, and 7, which will be like 2025, 2026, and 2027 based off the 18-year land cycle. So straight off the bat, over the next 3 years, units will perform better in this area versus houses. So now let's look on from a 20-year period. So from 2005 to 2024, we can calculate the capital growth. So back in 2005, we'll start with units. We're selling for, I'll just get my calculator here ready. So units we're selling for 124,000. Just go round numbers. And these days, the medium is around 412,000. So 288,000 in terms of a dollar value, median growth value over the 20-year period. So 288. So now if we work out the percentage will be 288,000. Sorry, 288,000 divided by 124,000 back in 2005 equals 2.3 times 100 equals 232,000. Sorry, 232% capital growth over a 19-year period. So pretty good, pretty decent. So divided by 19. So on average, 12% every year. So it's pretty good for units, right? That's if you buy them at the right price point at the right time and hold them for a 20-year period, they'll perform. So this is established, looking at established units. Now let's move on to houses. So back in 2005, houses were, this is 20 years of houses for Woodridge, 179,000. So same again, let's go 179,000 minus what they are selling for medium price today of 623,000, 440,000 capital growth in terms of dollar terms. So 179,000 divided by 440,000 times 100, 40%. Let's run that again just to double check if I got that right. So let's just double check that. So 100 and so 623,000 minus 179,000 equals 444,000 capital growth. Pretty good. Divided by 179,000 back in 2005 times 100 is 248% capital growth divided by 19, 13% per year on average. So again, houses, yes, do have slightly better capital growth over a long-term horizon. In terms of the short term, next 3 years, based off the 18-year land cycle, the units are going to perform better because they're coming off a lower base than what houses did based off history. So times 19. So over 19 years, 249% capital growth minus 232% capital growth for units is you would have seen an extra 16% capital growth for a house in Woodridge over a 19-year period than, or 20-year period than the units. So yes, there is higher capital growth for a house. However, what they don't tell you is the people that push houses and don't like getting into units at all is for the price you pay for a house versus a unit, you can get into two or three, if not four in some cases, units versus only getting into one or two houses. So you'll be able to buy more property as the banks will lend you more money for units because they have a higher rental yield and they have a lower entry cost than the houses do. And they more or less perform in the same pattern, in the same growth cycle. So I am a big advocate of buying units in the metro markets due to the price point. And I'm not saying go and buy, $500 million unit for new and off the plan stuff. That's not the product we like to buy. We like to buy established apartments in small boutique blocks, maximum 25 units in a complex, and ideally between that 10 to 16 is a sweet spot. Less than 10, people sometimes think buying in a block of four, three or four is better, but the risk is higher in terms of maintenance, ongoing cost. If a roof goes, it's divided by four people, whoever they need to stump up the cost to fix it. If something major goes, maintenance requirements. So the more unit holders, the more diversified the risk is for maintenance and upkeep of that unit. And that's why the banks love them. The banks love diversifying risk and a strong cash flow. So if you're getting into complexes around sort of 10 to 20 is a good number. Not going too high, like 30, 40, 50, 100 units, because then you got all gyms, lift pools, all the bells and whistles, and that's high maintenance higher running costs. But the sweet spot between, let's say, 10 to 20 units or townhouses or villas in a complex is a good sweet spot where you get the strong yields of 6, 7% on purchase price. You can buy them well under the replacement costs. I mean, these days we're picking them up as low as 270, 260,000, 250,000. They have good growth because the bottom end always rises, even in a downturn where people feeling the pinch to during a recession or a crisis, they can't no longer afford the $1 million plus house, can't afford to live in the fancy area, rent the fancy home. What do? They sort out for affordable accommodation. So this entry level established apartments always is in demand and will always go up, provided you buy at the right price, at the right time, at the right market, with the right yield, in the right complex that's not super sexy flash, minimal landscaping, minimal maintenance upkeep works, and the banks love them. That's the main key that most people miss is the banks would prefer you to go and buy a unit than buying a house. Because when you buy a house, sure, you'll get, a little bit more capital growth over the long term, 10, 15% over 20 years than a unit. However, an established unit that is, not a new and off the plan unit that can be suppressed and you overpay. However, when you buy a house, you are responsible for the whole site, maintenance, upkeep, everything. That whole structure is yours. So that risk is what banks factor in. That's why people that only push houses will get stuck because the banks will stop lending you money. It's a game of finance. Property investment is a game of finance with some houses thrown in the mix and units just for good fun. It's a game of finance. It's about getting the money out of the bank to keep reinvesting your money and making money on the bank's money. That's the game. It's a game of finance. So don't get caught up with, we have to buy a house, we have to do this, we have to renovate, all that stuff is great. But at the end of the day, property investment is a game of finance. And what do the banks love? Units. You can never go wrong with 2-bed, 1-bath, 1-car space units. The biggest developer in Australia, Harry Triguboff, only invests in building residential high-rise apartments. He started by building a modest block of 4 units, went from blocks of 4s, blocks of 6s, 8s, 10s, 12s, 20s, 100s. These days he's building minimum 1,000 units in one building. So if the biggest guy in the industry, the biggest investor in Australia, biggest property guy, biggest property investor and developer in Australia invests in that product, that's a pretty good blueprint, which is what we follow. We like to buy established units in the metros. So you're not sacrificing on your yield. If you're going to go buy a house, the banks love them. You can strip your equity out. We buy them in subdued markets, just like what we were doing in Brisbane between 2018 to 2023. Before it hooks through its growth cycle, we then can refinance multiple times to get money back out. They cash flow free property. I mean, we're buying them for 150, 160 grand at the start of the growth before it started the growth cycle. And these days they're worth 400,000. We've leveraged them multiple times, got our money back out plus more. We're now into them for 150, 160% finance. Got that money out, put that into other assets to keep on growing and moving forward efficiently and sustainably, rather than locking yourself up into houses in the metro. So units in the metros, we still like to diversify. So we get into regional houses that can have development upside by a modest granny flat subdivision, duplex conversion, or you may want to knock it down and build a block of 3 or 4 units down the track, not straight away, 10 years down the track once it stacks up. Developers typically buy sites, they sit on them for 5 to 10 years minimum before the market moves. Once the market moves, it then stacks up, then it becomes a profitable job, then develop it. If you want to go down that route, we can explore that. And then once you're into a couple of houses, that's when we look to get into multifamily. So duplexes, 2 units on one site for around the 500 grand mark, blocks of 3s around the 600 grand mark, blocks of 4s, 700, 800, and the sky's the limit. You can buy blocks of 10s, 20s, and we like to stick to less than 20 in a block. And that is the ultimate landing spot. You want to land in blocks of units, and that's how we can help you build a solid residential foundation portfolio. Reach out today if you want to chat further. Until next time, see you on the next one. Thanks for watching.